more money you make, the more you have to pay in taxes, right?
Today, we're diving into the exciting financial strategy called velocity banking. But don't worry, we'll break it down into simple terms so everyone can understand. So, let's get started. Paying off a mortgage can be a burden, and many of us dream of owning our homes outright without the weight of debt. Unfortunately, there aren't many legitimate options or solutions to help us pay off our mortgages faster, aside from making larger monthly payments. However, a method gaining attention is called velocity banking, which claims to enable you to pay off a 30-year mortgage in as little as 5 to 7 years. To leverage velocity banking effectively, there are certain requirements as well. Home equity. You need some equity in your home, although a substantial amount is unnecessary. Sufficient equity is needed to qualify for a home equity line of credit, HELOC, which uses your home as collateral. Good credit score. A solid credit score of 680 or higher is preferable to qualify for a HELOC or other credit facilities. Credit card for living expenses. You'll need a credit card to cover your regular living expenses, which will be paid off using HELOC funds. Positive cash flow. It's important to have a positive cash flow, meaning your monthly income exceeds your expenses. This surplus allows you to allocate more funds towards paying down your mortgage. While substantial equity is unnecessary, having more equity in your home enables you to obtain a larger line of credit, accelerating your progress in velocity banking. The main reason to consider velocity banking is that with a traditional 30-year mortgage, a significant portion of your monthly payment goes towards interest during the initial years. Looking at an amortization table reveals that only a small portion of the payment is applied to the principal. Over time, more payment is allocated to the principal, but it takes a while to make noticeable progress. Velocity banking aims to reduce the mortgage balance faster by making larger principal payments. Doing so can decrease the amount of interest paid over the long term. The faster you pay the principal, the less interest you'll ultimately pay. So how does velocity banking work? Well, it's all about using a line of credit as your main account and using any extra money to pay off the mortgage or other loans. Let's go through the steps involved in velocity banking. Step 1. Begin by applying for and opening a home equity line of credit, HELOC. In this example, let's assume you secure a $20,000 HELOC. Step 2. Use the funds from the HELOC to reduce your mortgage balance by $20,000. Essentially, you're replacing some of your mortgage debt with HELOC debt. Step 3. Embrace the banking aspect of velocity banking. Treat the HELOC as your primary checking account. When you receive your income from your employer, promptly deposit into the HELOC account, using your entire take-home income to decrease the HELOC balance. Step number 4. Cover your living expenses throughout the month using a credit card. Step number 5. Once a month, utilize the HELOC to pay off the credit card balance and your regular monthly mortgage payment. Step number 6. With a positive monthly cash flow, make consistent payments to reduce the HELOC balance. Once the HELOC balance reaches $0, proceed to make another $20,000 payment from the HELOC to the mortgage, restarting the process. As you continue the cycle over time, you will gradually pay off the remaining balance on your mortgage, leaving only the outstanding HELOC balance to be addressed. Upon eliminating the HELOC balance, you'll also achieve the proud status of being the owner of your home, completely free from any mortgage or HELOC debt. To illustrate the concept, let's consider an example. Assume you currently have a mortgage balance of $200,000 and your home is valued at $250,000, giving you $50,000 in equity. Let's say you obtain a $20,000 HELOC and immediately use it to reduce your mortgage balance. Now your mortgage balance becomes $180,000 while the HELOC balance is $20,000. To implement velocity banking, you'll use your paycheck to pay the HELOC balance and rely on your credit card for your regular living expenses. When the credit card payment is due, you'll utilize the HELOC to settle the credit card bill. In this example, let's assume your monthly take-home pay is $6,000. And your living expenses, including the regular mortgage payment, amount to $5,000. This leaves you with a monthly free cash flow of $1,000. You'll allocate $6,000 each month to pay down the HELOC balance and use the HELOC to cover the $5,000 of your expenses. With a positive cash flow of $1,000 per month, it'll take approximately 20 months to completely pay off the HELOC and bring the balance to $0. At that point, you'll initiate the process again by withdrawing another $20,000 from the HELOC and applying it towards the mortgage balance. The cycle will repeat every 20 months. Velocity banking helps you beat the bank at their own game in a few ways. First, you pay off your debt faster and pay less interest overall. Second, it allows you to use your money more efficiently, giving you more flexibility for other purposes. Third, it can improve your credit score, making it easier to get approved for loans in the future. There are several drawbacks to consider when it comes to velocity banking. Limited eligibility. Velocity banking is not suitable for everyone. It requires having equity in your home, a good credit score, and positive cash flow. If you lack any of these criteria, velocity banking may not be a viable option. Complexity and long-term effort. Velocity banking can be complex to understand and implement. It takes time to grasp the concept and fully comprehend how it works. Maintaining the strategy over the long term requires consistent effort and dedication. Complicated financial strategies often prove challenging for most individuals. Potential for increased debt. By taking out a home equity line of credit, HELOC, there is a risk of accumulating additional debt. Access to funds through the HELOC may tempt some individuals to make impulsive spending decisions or face unexpected expenses, resulting in a lack of progress or even an increase in overall debt. Demand for discipline. Discipline is crucial when practicing velocity banking. It requires financial discipline to stick to the plan and stay on course, especially when faced with unexpected circumstances. Maintaining the necessary discipline over an extended period is essential for successful implementation. Singular focus on mortgage payoffs. Velocity banking prioritizes paying off the mortgage aggressively, often leaving little room for other financial goals such as saving or investing. This strategy's concentration on mortgage payoff may limit flexibility in pursuing other financial objectives. Variable interest rates. Home equity lines of credit often have variable interest rates. While rates may currently be low, if they rise in the future, it could result in increased interest payments, affecting the overall effectiveness of the velocity banking strategy. Best case scenario models. Many online models and examples of velocity banking illustrate best case scenarios that may not align with real life situations. Unexpected events and challenges can arise, which these models and examples do not account for, potentially leading to different outcomes in practice. Potential scams. Beware of scams related to velocity banking. Some companies or individuals may offer expensive software or assistance, claiming to enhance implementation of the strategy. However, paying for such services is unnecessary, as velocity banking can be executed without additional cost or specialized assistance. In conclusion, velocity banking offers a promising approach to accelerating mortgage payoff and achieving financial freedom. While it may not be suitable for everyone, those who meet the eligibility criteria and possess the discipline can benefit from its advantages. By leveraging a home equity line of credit, HELOC, and making strategic payments, borrowers can reduce their principal balance faster, saving significant amounts of interest over time. Velocity banking encourages financial awareness and focuses on mortgage payoff, helping individuals stay committed to their long-term goals. Although it requires effort and understanding, the potential rewards make it a compelling option for those looking to become debt-free and own their homes outright. With careful planning and a dedicated mindset, velocity banking can pave the way to a brighter financial future. That's it for the video. Thanks for watching.